He sees the potential for a more than $3 trillion market cap company. You own the stock.
Yeah, sure. I mean, as an owner of the stock, that would be fantastic. I do want to touch on a couple of the points that Eric made, and I think it goes back to the consumer experience. You know, with so many handsets being out in the marketplace, Apple's really focused now on being able to continue to enhance the user experience. And so I think when we think about where are they investing, it's really to make sure that we continue to be on our phones. And so I do agree that services is the path forward in terms of revenue generation. If it affords them a higher multiple in a future state, that's fantastic. But I think we have to get to the second half of the year where we start to get to the back half of this refresh cycle and see if we can get some demand back from China and Europe, which has essentially been dormant over the last few quarters, in order to get some momentum back in terms of investor sentiment.
See, at some points, Joe, you need to look past the ebbs and the flows of the near-term movement of the stock and look out over the horizon like Eric does and suggest, you know what, they can unlock that level of success in the stock that you could get another $1 trillion in market cap through that hardware subscription service. I raised the question to you that way because you sold out of it not that long ago, saying that it had both lost its quality and momentum, at least in the near term, the way you look at things for your ETF that you actively manage.
Yeah, so Apple has always been a steady hand in a portfolio. And when you study the two factors of quality and momentum, the real deterioration, if you want to even call that, in quality was just the slowdown in the revenue growth. Over the last 3 years, you're talking about a company that's hit revenue growth in the mid-teens. You actually had a contraction in the revenue growth, and we know that was attributable to subscription. So that can restore itself quickly. What also can restore itself quickly is the momentum factor, and the momentum factor for Apple, for the very first time in several years, was lost in the last quarter. Apple's in the same place, Scott, that it was in July of 2021. Now, that's where the red light turned on. The red light turned on because of momentum, not because of quality. And if you look at the fundamentals of this company, I have never called that into question. I don't believe, it's not in their personality to do the acquisition. Apple doesn't buy the growth. They don't need to. Apple's all about investing in achieving organic growth, and they'll achieve that once again. I'm sure that I, as well as the strategy, will go back into Apple once again. And by the way, Apple, so far year to date, it is in the process of rebuilding some positive momentum. 155 to 160 over the next, call it 45 to 60 days. You're able to sustain at that price level. You've restored the positive momentum in Apple once again.
If you didn't actively manage the ETF that you do, would you own the stock?
Without question.
You would?
Without question.
I ask you that because I'm wondering how you think our viewers should think about this name. Now, I would ask you,
I used the two words before, but I used the two words before, steady hand in a portfolio. That's what they are. Apple has the purest discipline of all the technology companies. They don't go out and make risky bets in markets. They don't go out, and Eric is 100% right. They sit back. They are the second mover.
I love the way he said it. They like to build rather than buy.
They're the second mover. They sit back, they observe, and then they make the environment or the product better. That's exactly what Apple has done so successfully over the last several years. Listen, fundamentally, if you're giving me a company that's going to buy back a boatload of their stock, return a little bit of a small dividend to the shareholder, that's a great company. I'm following my strategy. That's why, for now, I'm out of the stock.
Shannon, what about tech? Let's just use this as an opportunity. Ending a month, January, February, pretty good year to date. Tech's the second best performing sector. Does it continue? And this stock is obviously going to have to still do well if it, as in tech as a whole, is too.
Absolutely. I mean, I think we're still going to end up talking about major tech players here as we think about the potential for the NASDAQ to continue to perform. Scott, there has been a ton of excitement coming into this year about a pause or a pivot. We've seen rates rise, and, frankly, I've been surprised at the resilience of big tech. You know that we have a pretty large weighting in the sector, but I think it's important to continue to look at technology and differentiate, as we've talked about, from tech companies that have strong operating margins, from really strong balance sheets, free cash flow, and profitability. And I think if you continue to think about tech being able to lead us through over the next couple of years, I still think we're going to see some fits and starts, especially if we see rates kind of creeping up higher over the next month or so. But I think that right now is a great time to consider, if you don't own some of these market-leading tech companies, and I would say Apple and Microsoft are two of them, that, initiating a small position. We're certainly down from our highest point weights over the last 3 or 4 years, but that's not because we don't like the companies. It's because we continue to diversify in the sector.